There's a $1 billion pipeline sitting on the table, a 256 qubit milestone this year, a system called tempo shipping next year, and a bold claim, 2 million qubits by 2030. But here's the real question. Is this the early innings of America's next strategic infrastructure build-out? Or are investors getting ahead of physics? Because when a company positions itself at the intersection of national security, scalable computing, and semiconductor manufacturing, the upside narrative writes itself. The risk, however, doesn't disappear. Today we're breaking down IonQ's roadmap through 2030, the Federal pivot, the qubit milestones, the SkyWater acquisition, and what it actually means for serious investors. No hype, no doom, just the numbers, the strategy, and the probabilities. IonQ is no longer pitching itself as just another quantum experiment. The company is deliberately aligning with U.S. national priorities. In the third quarter of 2025, IonQ launched IonQ Federal, sharpening its focus on government contracts. Management cited over $1 billion in proposals in progress, not bookings. Proposals. That distinction matters, but so does the signal. Roughly 70% of third quarter revenue came from the U.S., 30% international. That's a notable shift. The prior year was far more domestically concentrated. And when you combine Department of Energy partnerships with the earlier EPB hub sale, a pattern forms. IonQ is embedding itself into federal infrastructure conversations. This isn't about short-term hardware sales. It's about becoming part of the long-cycle procurement machine. And that machine moves slowly until it doesn't. Third quarter revenue came in at $39.9 million. That's 222% year-over-year growth. More interesting? Management guided fourth quarter revenue above the third quarter, breaking historical seasonality patterns. They also raised full-year guidance. Now, sophisticated investors don't just look at growth percentages. They look at trajectory shifts. Breaking seasonality suggests pipeline conversion or milestone billing timing is improving. But remember, adjusted EBITDA losses remain guided between $206 million and $216 million for 2025. So we're still firmly in the investment phase. Revenue acceleration, cash burn persists. Classic early-stage infrastructure profile. This year, IonQ plans to demonstrate a 256-qubit system with electronic qubit control. In 2026, they plan to ship tempo. Milestones like these are more than marketing checkpoints. In quantum computing, qubit count is only part of the equation. Logical qubits, usable error-corrected computational power, are what determine commercial viability. IonQ is targeting 1,600 logical qubits by 2028, 80,000 logical qubits by 2030. If achieved, that shifts them from experimental deployments to scalable enterprise systems. But that word, if, carries weight, because roadmap execution risk is nonlinear. Delays compound, adoption elongates, and investor patience compresses. By 2028, IonQ expects functional testing of 200,000 qubit processing units. Then comes the headline, figure, 2 million qubits. Management even accelerated the timeline by up to a year. Ambitious? Absolutely. Impossible? Not necessarily. But physics doesn't negotiate. If they achieve scale with high fidelity, this unlocks government-scale optimization workloads, advanced cryptographic modeling, AI-adjacent hybrid computing, and defense simulation applications. And that's where the national security alignment becomes critical. Quantum supremacy isn't just commercial, it's geopolitical. IonQ plans to acquire SkyWater technology for approximately $1.8 billion. This isn't random. SkyWater operates a DMEA Category 1, a trusted onshore foundry. Translation: secure US-based semiconductor manufacturing. Vertical integration means faster wafer iteration, parallel prototyping, supply chain control, and cost compression over time. An independent review suggested parts needed to build a 2 million qubit system could cost under $30 million in 2025 dollars. If accurate, that changes the margin equation dramatically. But again, that's future state modeling, not present-day profitability. Let's ground this. Losses continue into 2026 according to consensus projections. Research and development spending will rise, SG&A will increase. The $1 billion pipeline consists of proposals, not binding contracts. Multi-year sales cycles reduce visibility. And quantum commercialization globally is still early. If tempo shipments slip, if qubit milestones delay, if government funding priorities shift, the revenue ramp stretches and valuation compresses. This is not a low-volatility equity. Here's the balanced view. IonQ is building optionality. If milestones hit and federal adoption scales, 2026 revenue acceleration could be meaningful. If vertical integration improves unit economics, long-term gross margin expansion becomes plausible. But today, this remains a roadmap-driven valuation story, meaning the stock trades on belief in execution. For investors, high conviction required, time horizon likely multi-year, position sizing discipline critical. This isn't a trade based on next quarter. It's a thesis based on 2028 to 2030 milestones. The asymmetric upside case exists. So does material execution risk. That's what makes IonQ interesting. Not certainty, but probability dispersion. The market is trying to price a future that hasn't happened yet. And when that happens, volatility isn't a bug. It's the feature. The question isn't, is IonQ guaranteed to win? The real question is, does the probability-adjusted upside justify the risk at today's valuation? That answer depends entirely on your time horizon and your tolerance for roadmap execution. If you want more deep-dive infrastructure plays analyzed without hype, subscribe. Because the next decade of computing won't be decided by headlines. It'll be decided by who actually ships and who doesn't.